Hello dear friends, my name is John AG. Today is Wednesday the 4th of February, and as you're watching this, the metals market has just done something that feels almost unreal. In the last couple of sessions we saw panic, a brutal knockdown, and then bang, silver snaps back with a green candle so large it practically shouts through the screen. And here's the part that should make you lean closer. The rebound isn't happening in isolation. Gold is climbing with it. Miners are waking up. Even the forgotten metals, platinum and palladium, are joining the move. That kind of broad rally usually means one thing: something bigger is shifting under the hood. Now before we go any further, I need to ask you for a quick bit of support. I'm running a campaign to push back against copycat channels that recycle other people's work, and your engagement is the weapon that actually works. If you value this kind of breakdown, hit subscribe and drop any comment, even just our John AG, so the algorithm knows you're here and you want more. Alright, let's get into it. Because what I am about to show you is why this V-shaped bounce might be the start of the next leg, not just a dead cat bounce, and what the market could be trying to hide in plain sight. First, let's look at gold. On the chart, you can almost see the story written in the candles. Gold had pushed up, broken above a consolidation range, then got shoved back down into that same box like someone slammed it or in its face. The lower boundary got tested, and for a moment it looked like the floor might give way, but it didn't. Buyers stepped in hard, and now gold is pressing back upward again, flirting with that psychological 5,000 level like it wants to reclaim it out of pure spite. When you see that kind of rejection, when a breakdown fails and price snaps back, technicians call it bullish, but you don't need fancy labels to understand it. It means there's demand sitting underneath, waiting for weakness, ready to buy the dip the instant fear shows up. And now silver is the star of this show, and you can feel it. We had a savage decline across 2 sessions, one of those moves that makes even experienced traders stare at their screen and say, "What just happened?" Then, almost as fast, we get the reversal. A tall green candle, a rush of bids, a sense that the market tried to smash it and at least today failed. If you bought the dip, whether with paper positions or simply with physical, congratulations, that takes guts. But here's the truth that most people won't say out loud after a move like the one we just lived through, literally. Anything can happen next. That's not drama, that's reality. Because markets like this don't behave politely, they behave like a system under stress. And when a system is under stress, you can get violent swings, fake outs, and sudden reversals that feel engineered. Let me put it another way. When you see a today hit that hard and then a snapback that sharp, you're not watching normal. You're watching a tug of war. Now, a quick note for the physical stackers, because I know many of you are. The number of ounces you hold doesn't change when the price flickers up or down in fiat terms. So if you're stacking for long-term security, the headline candle isn't the thing that matters most. What matters is whether the physical market is tightening, whether premiums are widening, and whether the real-world flow of metal is getting strained. Which brings me to the detail that keeps me up at night, the China price. Over in China, the local silver price has been trading at a premium to Western pricing, and that premium has not only returned, it's threatening to expand again. Think about what that implies. If the Shanghai price is meaningfully higher than the New York price, the obvious trade is to buy metal in the West and move it east. That's arbitrage, and in a functioning market, it should close the gap. But if the gap stays wide, it's not because the math doesn't work. It's because the metal doesn't move the way the models assume it will. And that is where the story gets dangerous. Because if arbitrage can't do its job, you don't have one silver price anymore. You have multiple silver prices. You have the paper price, the exchange price, the local dealer price, the overseas settlement price, and all of them can diverge in moments of stress. So here's the question you should be asking. Is this rally just a bounce, or is it the market admitting that the paper price is losing control? Hold that thought because we'll come back to it. Now I want to talk about something that most people ignore when they talk metals. Behavior, not headlines, not slogans. Behavior. When silver fell, it didn't scare everyone away, it pulled buyers in. That matters, because a classic sign of a real bottom is when price drops and demand increases. When weakness triggers a stampede of physical buying, you've just found a layer of support that doesn't show up on a chart, and we saw evidence of that. Dealers reported unusually high volumes, mints reported strong sales, websites struggled under traffic. In other words, the moment the market tried to reset the price lower, real people treated it as a discount. That is not bearish. That is foundational. Now, am I saying silver must rocket straight back to the previous highs tomorrow? No, not at all. After a shakeout, the market often chops. It often tests nerves. It often grinds sideways just long enough to bore the impatient and punish the over-leveraged. But if this rebound holds, if price can reclaim key trend lines and close strong, then the next all-time high can arrive faster than most people are emotionally ready for. And this is where we need to talk about the structure of the move. On the chart, you can draw that rising bull trend from earlier in the run, the smashdown punched. Below it, that looks scary, but what matters is what happens next. If silver pushes back above that line and holds it, then the breakdown becomes a trap, and traps are fuel, because shorts have to cover, and cautious buyers rush back in, and suddenly the move accelerates. If instead, price rises into that line and gets rejected, then we may get consolidation, maybe a messy sideways range. Maybe another nasty flush, maybe both. Either way, the message is the same. The market is not calm, the market is stressed, and stress creates opportunity, and it creates danger. Now, while we're here, do me a favor. Tell me in the comments, did you buy that dip, or did you watch it and promise yourself next time? And second question, do you think the China premium is the real signal, or do you think it's just noise? I read every comment, and your answers shape what we cover next. Okay, let's widen the lens, because the metal story isn't just about metals. It's about capital rotation. It's about where money goes when a crowded trade starts to crack. And right now, there are cracks in a place most people think is invincible. High-priced tech and the private credit machine that helped fund it. There's growing chatter that parts of private credit, those less transparent lenders that sit outside the normal banking system, are exposed to software and tech businesses that were priced for perfection during the easy money years. Companies were bought at sky-high valuations when rates were low and optimism was unlimited. Now the world has changed. Rates are higher, growth is harder, and artificial intelligence is threatening to turn some of those business models into yesterday's news. If that sounds abstract, let me make it concrete. Imagine a lender funds a deal to buy a software firm at a rich multiple, assuming steady cash flows for years. Then a wave of AI tools arrives and makes the product cheaper to build, cheaper to replicate, and easier for competitors to match. Revenue slows, margins compress, and suddenly those safe cash flows aren't so safe. What happens next? Defaults rise, lenders take losses, confidence drops, and the market starts to question the valuations it once treated like gospel. Here's why that matters for gold and silver. When a bubble deflates, money doesn't always disappear. It relocates, it searches for shelter, it hunts for what is undervalued, what is real, what cannot be printed. In past panics, gold sometimes fell alongside everything else because people sold what they could to cover what they had to. But if the next panic is simultaneously a confidence crisis and paper promises, then metals can behave differently. They can become the lifeboat rather than the casualty. And if that happens, the move you're watching right now, this violent rebound, could be the early warning flare. Now let's talk about China again, because China is the quiet hand in this market. China has been a persistent buyer of gold, especially on dips. When price drops, demand tends to show up. That creates a kind of invisible floor, a bid that doesn't announce itself on Western TV, but shows up in the tape. And when a country is serious about building reserves, it often buys more than it publicly admits. I'm not asking you to take that on faith, I'm telling you to understand incentives. If a nation wants flexibility in a world where currencies can be weaponized, it seeks assets that are hard to sanction and hard to freeze. Gold is the classic answer. Silver, in certain contexts, becomes the industrial cousin, strategic, necessary, consumed by technology, and increasingly difficult to replace. So when you see a persistent premium in an overseas market, it is worth asking, is this just local demand or is it a signal of strategic accumulation? And if strategic accumulation is happening, then the next question becomes uncomfortable. How much metal is actually available at these paper prices? Because paper can trade endlessly, physical cannot. Now I need to weave in something practical, because many of you want daily updates beyond YouTube. If you want quick posts, instant notes, and my personal analysis the moment something breaks, I set up a WhatsApp channel. The link is in the description. That's where I share premium updates I don't always put on YouTube, including rapid voice notes when the market moves fast. Also, as you're watching this, a members-only video should already be live. If you join the membership, you'll get one video that bundles the latest updates plus deeper analysis, and it helps me see who's really following along when the noise gets loud. Now back to the charts, because this is where the tension lives. In gold, the reclaim attempt near that psychological level is not just a number game, it's a confidence game. When gold approaches a big round number, people who miss the move get nervous, late buyers hesitate, and sellers hope for a rejection. If price slices through anyway, it creates a different emotion, regret, and regret is gasoline. In silver, the story is even more emotional because silver is the metal that humiliates both bulls and bears. It rockets when you least expect it, and it crashes when you feel safest. It is the perfect instrument for shaking out weak hands. That's why, after a move like this, the correct stance is not arrogance. The correct stance is awareness. Now let me say something important about physical premiums and dealer spreads, because this is where retail investors get trapped. When markets get wild, the difference between buy and sell prices can widen dramatically. Some dealers get overwhelmed with demand and raise premiums. Others get overwhelmed with supply and lower bid prices. You might see a situation where you can only sell far below spot, while you have to buy far above spot. So if your plan is to trade physical like it's a stock, you're going to get punished. Physical is for holding, not day trading. If you're trading, you trade paper, ETFs, futures, or liquid instruments where spreads stay tight. For physical, the smart approach during chaos is patience. Accumulate when you can, don't chase frenzies. And don't panic sell into the worst possible spreads. Now here's a cliffhanger for you. The rally we're seeing today looks impressive, but the real tell is not the candle itself. The real tell is what happens when the market tries to hit it again. Will the next sell-off be met with the same wave of physical demand? Will premiums widen further? Will Shanghai stay elevated? Or will the gap close and tell us the stress is easing? Because one of those outcomes points to a normal correction, the other points to a structural shift, and if we are in a structural shift, the move could be larger than most people expect. Let's slow down and actually walk the candle, because the details matter. Picture the session like a story. Early on, silver is still bruised from the prior hit. Sentiment is fragile, and the first buyers step in carefully. Then, as price starts to lift, you see the momentum traders sniffing it out. Volume builds, stops get triggered, shorts begin to feel that familiar tightness in the chest, and then the market does what it loves to do. It runs to the place that hurts the most people. That's why the shape matters. A V-shaped recovery is not just a pretty letter, it's an emotional reset. It says the crowd that sold in fear was wrong, at least for now. And when people realize they sold the bottom, they don't just regret it. They chase, they re-enter, they pay up. And that creates a second wave. Now zoom out. When you zoom out, you can see why so many people get trapped. A strong rally makes you feel like you must act. A strong crash makes you feel like you must act. The market is constantly trying to force action at the worst times. So if you're stacking physical, your superpower is boring discipline. You buy when you can, at reasonable spreads, and you ignore the theatrics. But I also know some of you do trade paper, and if you're in that camp, you need to treat these days like a storm warning. Spreads on liquid products may stay tight, but the whipsaw can wipe you out if you're oversized or overconfident. A move that looks like only 5% can be a death sentence with leverage, and we just watched swings that were not polite. Now let's talk about premiums and real-world availability in a way that's useful. People ask me, what should I watch besides price? Here are 3 practical indicators. Number 1, dealer inventory and delivery times. When you see common products going out of stock or delivery time stretching, that's not just marketing, that's supply friction. Number 2, buyback prices. If dealers suddenly offer much less than spot to buy from you, it can mean they're drowning in supply or they can't offload. If they offer closer to spot or even above for certain items, it can mean they need metal badly. The key is that it can vary by region and by product type. Number 3, the premium split between regions. When one market repeatedly pays more, it's not a meme, it's a signal that demand and settlement mechanics differ across the world, and that brings us back to the China premium again. If the local China price converted into dollars keeps printing higher than the West, it creates a pull. It says metal belongs over here more than it belongs over there. You can call it arbitrage. You can call it flow, but in the real world it becomes a vacuum. Now here's the twist. People assume that if there's a premium, someone will immediately ship metal to close it. But logistics, form factors and rules matter. If the metal that settles on one exchange needs to meet specific standards, you can't just toss random bars on a plane and call it a day. Refining capacity matters, location matters, timing matters, and in a stressed market, those bottlenecks turn into walls. That's why the premium can persist longer than textbook finance says it should. And when it persists, it tells you the system is not as fluid as people believe. Now let's anchor this in a simple mental image. Imagine there's a river of silver. It normally flows through familiar channels. Mines, refiners, wholesalers, mints, industrial buyers, investors. Most of the time the river moves smoothly. But when a dam forms, export rules, refinery constraints, inventory depletion, settlement demand, the water level rises on one side. That rising water level is the premium. So if you keep seeing the water level rising in one place, you should stop and ask, where is the dam and how strong is it? Now, I want to address the junk silver underspot type of situation because it confuses people. Sometimes you'll see certain products offered near spot or even below. That doesn't automatically mean silver is abundant. It can mean that product is in a specific inventory position. It can mean dealers are managing cash. It can mean they're trying to move less desirable items. And sometimes, yes, it can mean they're overwhelmed with supply in that category. But here's the key. In chaotic periods, you can have pockets of cheap metal and pockets of expensive metal at the same time. That's how fractured markets behave. And that fracture is exactly why it is so risky to trade physical aggressively during a spike in volatility. Now let's return to the bigger macro thread, because this is where the why lives. The modern system is built on confidence in paper promises, bonds, credit, derivatives, and the belief that liquidity will always be there when you need it. When confidence is high, people chase returns, they buy the story assets, they pay absurd multiples, they borrow to do it. And as long as the music plays, it looks genius. But when the music stutters, everyone suddenly looks for the exit at the same time. Now let's talk about the psychology of the 5,000 level in gold again, because it's a perfect example of how humans behave. Round numbers attract attention, they become headlines, they become memes, they become targets. Price hovering near a round number creates attention. Bulls want a breakout, bears want a rejection, and everyone else waits for confirmation. But confirmation usually arrives after the move has already happened. So the market uses that hesitation. It fakes you out, it wicks above, then back below, or it dips under, then reclaims. It tries to trap you into reacting late. That's why I keep saying, don't watch price, watch behavior. Now in silver, behavior is even more dramatic. Silver doesn't do subtle, it does violence, it does euphoria, it does betrayal, and then it does another betrayal in the opposite direction. It is the metal of whiplash, and that's why the current moment is so interesting. Because if the market wanted to break sentiment permanently, it would want a crash that stays crashed. It would want buyers to hesitate. It would want people to stop bidding. But we didn't see that. We saw demand show up. So here's the next cliffhanger. What if the smashdown was not only about profit, but about morale? What if it was meant to make people think the rally was over? And what if the opposite happened? What if the smashdown created more conviction? If that's the case, the next run can be even more explosive, because it converts skeptics into believers. Now, if you are someone who wants a simple framework, here it is. Ask yourself 3 questions. 1. Is the metal price trending up over months, not just days? 2. Is physical demand rising on dips, not just on breakouts? 3. Is the global premium structure hinting at real-world tightness? If the answer is yes to all 3, you have a bullish setup, even if the day-to-day is chaotic. Now, I want to bring us back to community for a second, because the most valuable part of this channel is not just my voice, it's your experiences. If any of you have built a stack over time, or used discipline to pay off debt, or turned a side hustle into stability, share one practical sentence. It helps others. It also signals to the platform that this isn't shallow content. Now, one more practical tip. If you're buying physical during chaos, do not just buy the first thing you see. Compare premiums, compare shipping, compare payment methods. And if you're selling, understand that dealers manage risk too. A wide spread is not always greed. Sometimes it's survival in volatility. Now let's talk about time, because time is what turns a spike into a trend. Today's candle is 1 day, the smashdown was 2 days. The larger story is months and years, industrial demand, supply constraints, strategic stockpiles, and the slow erosion of confidence in fiat. And that erosion doesn't happen all at once. It happens like a crack spreading across glass. Most people ignore it until the day the glass shatters. So you don't prepare on the day it shatters, you prepare before, and that is why these moments matter. They teach you how the market behaves under stress, so you can recognize the next move earlier. Now, final cliffhanger before we close. If the premium abroad stays high, and if physical buying keeps intensifying, and if the next dip gets bought even faster than the last, then what happens when the paper market tries to cap the price? Again? Because at some point, the cap stops working. And when it stops working, the move is not gradual, it's sudden. That's the moment people call unprecedented after the fact. The question is, will you recognize it while it's happening? Now, as we head toward the end, I want to introduce you to something slightly different for a moment. If you're also interested in silver-related success stories, real cases of how people built wealth and discipline through metals, there's another channel linked in the description. Go check it out and subscribe. It's a different angle, and it's surprisingly motivating. Alright, let's connect the dots between the metals bounce and what's happening in the tech world, because this is the part that could drive virality if you understand it. We are living through a moment where AI is not just a buzzword, it is a force that can compress industries. Tools are arriving that let non-experts produce outputs that once required teams of specialists. That changes profit pools. When profit pools change, valuations change, and when valuations change in an over-leveraged system, defaults can follow. Now imagine that at the same time, the global currency backdrop is unstable. Deficits, debt, geopolitical tensions, payment systems used as leverage. In that world, investors crave assets that aren't somebody else's. Liability, gold and silver fit that psychology. And when that psychology takes hold, the move can become self-reinforcing. Rising price draws attention. Attention draws buyers. Buyers draw higher premiums. Higher premiums signal scarcity. Scarcity draws more buyers. That is how you get a mania. Are we there yet? No, but the pattern rhymes, and today's bounce might be one of those early, easily ignored signals that later looks obvious in hindsight. Now, let me be clear. I'm not telling you to gamble. I'm not telling you to over-leverage. In fact, after what we just witnessed, leverage should scare you. It should remind you that paper can be whipped around violently. But I am telling you to pay attention, because if you blink, silver can move $20 and you'll spend the next month saying, I can't believe I missed it. Now let's talk about what could happen next in practical terms. Scenario 1. Silver consolidates, price chops sideways under a key trend line, sentiment cools, traders get bored, physical buyers keep accumulating quietly, then a catalyst hits, maybe a macro shock, maybe a currency headline, maybe a supply squeeze, and silver breaks upward into new highs. Scenario 2. Silver rallies into resistance, gets smacked again, and we see another quick flush. But here's the key. If the flush is bought just as aggressively as the last one, then the market is telling you demand is stronger than paper selling. Scenario 3. The premium overseas collapses. Arbitrage resumes. And the stress eases. That would suggest today's move was a temporary reset, still bullish long-term, but less explosive near-term. Which scenario is most likely? I don't pretend to know with certainty. Markets are probabilistic, but I can tell you what I'm watching, and you should watch it too. Premiums, spreads, and the behavior of dips, because behavior reveals truth. Now, I also want to add a friendly note that helps this community. If you've had success, whether with stacking, investing, business, or just getting your finances under control, share one line of your success story in the comments. It helps other people believe it's possible, and it turns this comment section into something useful. Rather than noise, alright, back to the immediate move. Gold pushing upward tells you the safe haven bid is alive. Silver surging tells you the risk appetite inside metals is alive. Miners lifting tells you equity investors are starting to smell profit leverage again. And that brings me to a concept that matters: operational leverage. When a metal price rises, miners can see profits rise disproportionately because their costs are relatively stable while revenue increases per ounce. That means miners can act like leveraged bets on the metal itself. But miners also carry risks: management, jurisdictions, financing, energy costs, and dilution. So if you're looking at miners, don't just look at the shiny narrative. Look at cash flow. Look at balance sheets. Look at whether they can survive when the market turns ugly. Now, here's another cliffhanger, and it's a big one. What if the biggest story isn't that silver bounced? What if the biggest story is that the smashdown failed to scare away physical demand? Because if the market cannot break the will of physical buyers, then paper selling becomes less effective over time. And if paper selling becomes less effective, price discovery starts to migrate toward the real market. And if price discovery migrates toward the real market, then the price can gap in ways that shock everyone. Now let's pull one more thread. The idea of multiple prices returning. We already see it in moments of stress. A screen price says one thing, So if industrial demand stays firm and supply remains constrained and investment demand rises when fear spikes, then you have the recipe for a squeeze. I'm not claiming the squeeze is guaranteed. I'm saying the ingredients are visible if you look. Now, as we close, here's what I want you to do. If you haven't already, subscribe. Keep it simple. It takes 1 second and it helps this campaign against recycled content actually work. And please leave a comment. Again, even Urgenag is perfect because it tells the platform that this community is real. Also, join the WhatsApp channel in the description if you want the faster updates. And check the members only video if you want the full bundle of recent moves and deeper breakdowns. Now, last thought, and I'll leave you with it. Most people watch silver like it's entertainment. They want fireworks, they want instant gratification, and they want certainty. But silver doesn't pay people who want certainty. Silver pays people who can handle uncertainty. We just witnessed a shakeout that punished leverage, punished complacency, and rewarded patience. If you can stay calm through that, you put yourself in the small group that actually benefits when markets get strange. So tell me in the comments, do you believe today was the turning point? Or do you think we're about to get one more trapdoor before the real run begins? My name is John AG. Thanks for watching. Subscribe, stay sharp, and I'll see you in the next one.